Here's something most property investors don't realize, that if you're holding onto a property that's draining your cash flow by about $300 or $400 a week, then your investment plans have a pretty good chance of stalling before they even really get started. So what I wanted to show you today was a real example of a real property that one of our clients has done that's got a holding cost of $20 a week. And just to show you how, when you run those numbers out, a property with that sort of holding cost can actually start to set you up for further investment as well, rather than putting your plans on hold. Let's dive into it. Okay, so we're just having a look at the numbers on this property. So this is a dual income property, as you can see here. And I won't sort of break into all the numbers, but I guess a couple of key things on this, just to give some clarification, is you'll see the capital growth rate there of 6%. So that's just a planning rate that we use. So the actual long-term growth rate for the particular location this property is in is actually 9.2. But from a planning perspective, we just bring it back to, a sort of a reasonable long-term average, which is around about 6%. But nonetheless, that market was actually doing 9.2. And the rent on that property was $850 a week. That's just an estimate in there. It was interesting. The bank actually put an estimated rent on that property of $920, but again, we probably pull things back a little bit, make it a little bit more conservative. So, $850 was pretty reasonable based on the numbers that we were seeing and what's likely achievable for that property in that market. The main number we're interested in here is the number at the bottom, which is the after-tax holding cost on this property, which came in at a starting level of $19 a week, or basically around about $1,000 a year in terms of holding cost on that property. You can see projecting that out, assuming that there's a bit of scope for increasing the rent over time. That's going to get basically neutral in the next 3 to 4 years or so. So that's the projection on that particular property. That's basically the scenario we're looking at for this client, but I wanted to show you how that then sort of fits into their strategy as well, and why that actually matters. So in terms of looking at this client's situation, they were, as at the time, they were 42 with a planned retirement age of 60, so about 18 years to retirement. So not a bad runway to work with. However, they still actually had quite a bit of debt. Their home loan was around about $803,000 at the time, and based on the current payments they were making into the loan, by retirement they were still looking at having an outstanding balance of about $226,000. When we had a look at what they had in super, and they had some shares as well, and we sort of rolled out projections on that, they were probably looking at around about 2.4 in investable assets of where they were going to end up. And based on that position and then netting out the debt, effectively sort of pre-tax, that would get them to around about 57,500 roughly, taking out about 10% out of the tax for that, depending on what the tax situation is at the time. But that's sort of the band we work in terms of the pre-tax, post-tax situation. Probably near enough to around about 50,000. So well short of where they wanted to be. The minimum they were aiming for was around about 100,000. So, in terms of looking at that, the shortfall that they would need to make up over the next 18 years was around about nearly 2.3 million, just to give you a guide. So basically, I guess we had a number of objectives there. One, obviously, to get them to a situation where, one, they could obviously have the home loan paid off, before they reach 60. And ideally, if they were going to take on investment, be in a position where that debt could be cleared as well. And obviously try and make up that shortfall of about that 2.3 at the same time. So a couple of objectives there. And that was part of the reason why we were looking at a fairly neutral sort of property, because given that property would effectively be able to cover itself, would mean that they could put more cash into the home loan and focus on paying that off sooner. So the first thing was looking at their home loan we could see that there was an opportunity to restructure what they were currently doing in the current home loan setup that would potentially let them pay off their home loan a lot sooner. So basically, in terms of getting that set up in a way where they're using the funds more effectively, that would potentially give them the ability to have that loan paid off in roughly about 9 years, as opposed to still having a debt there by the time they retired. So that was the first key step in terms of looking at their structure. So then looking at things from an investment perspective, how would that roll out for them? So if you recall, the investment gap they would need to make up was roughly around about 2.3 million. So with that one property alone, and obviously being able to focus on getting that home loan paid off pretty quickly in the meantime, if we roll that forward to 2043, that would actually set them up in a net position of around about 2.7 million. So that's basically net of debt. So at the end of the day, what we're looking at there is, the investment property, projected value at that point in time, probably around about the 2 mil mark. And in terms of the debt, while we're sort of showing up debt up here, how this is just how the system works. But if we look down here, there's a cash savings of 1.3. So 1.3 over the 798 means that debt's gone. And effectively, we've got a net position there of 2.7. So the target was 2.3. So potentially they could make up that shortfall that they were targeting with just one property alone. And obviously in combination with trying to get that home loan paid off quickly. So effectively that would mean they'd be able to retire without a home loan debt and without a debt on the investment property, which would probably set them up in a figure over that 100,000. But the thing is, obviously, there's given that position as well, they could probably go a little bit further than that. So with that home loan coming down a bit faster, they could potentially sort of jump into another property in around about 3 years' time, let's say. And if we then roll that forward out to 2043, we can see that gets into a position of around about 4 mil. So that would be a net asset position on top of what they already had in their investment pipeline. So, translate that back, that gets into an income equivalent of around about 180 to 190 a year. So well above where they would be, and still being in a debt-free position at that point. So I feel, overall, I guess there's two possible scenarios that could play out. They could just go with the one property and then just focus on debt reduction and get to a, pretty comfortable retirement income. Or if they decided they wanted to go, if that was working well, they'd have the scope there a couple of years down the track to maybe look at a second property and then potentially set themselves up into a much stronger position. So look, that's actually just one example of a property and one type of approach. But I guess the main thing that I was trying to show today was how making sure that your strategy and what you're doing property-wise actually line up together. And importantly, that you give growth and cash flow equal weighting, that we don't sort of put one over the other, but you can see the importance of how they can both work together to help you progress your plans long term. I hope you found that information helpful, and I look forward to seeing you in the next video.